So what are we going to talk about? We're going to talk about a few different things. We'll start with a little bit of a background on the timeline of tariffs, both kind of at a macro level, but then also at a micro level here more recently, as we think about the last 60, 90 plus days and what all is going on. Obviously, this has impacts on the supply chain and understanding, where are our inputs and finished goods coming from, and how is that impacting our ability to do business, get product to you, and what does it look like to the rest of the industry. We'll also talk a little bit about price versus availability. There's a lot of different things going on that are influencing price, but I think it's important to acknowledge what might be happening as it relates to product availability and what we can expect over the next couple of months, assuming we don't get another change in the next 24 hours, which it appears is almost always likely lately here. So then we'll dive into a little bit of state of the market and look at current farm economics, what the impact of everything that's going on has on the grain trade, as well as what weather and the season ahead can kind of help us figure out. We will talk a little bit through financial solutions. What is the interest rate impact from tariffs, and what options are available to growers to help free up some of that cash? And then we'll close out with a little bit of a focus on agronomy and talk through how we kind of start through, sharpening our ROI and making sure that we're looking at things through the right lens, not letting our emotions get in the way, and make sure we're setting up that crop for the best chance for success in the 2025 season. So before we get into content, we're going to do a little bit of experimenting here, and we're going to do a quick poll. And so I think Megan's going to go ahead and bring up a poll capability here in the background. And we want to know from you guys what to this point, and I'll wait until we get it up and loaded here. All right. Oh, almost. All right, we'll skip the poll question for now, and we'll come back to it at the end and see if we can get that to work. So I'll keep us moving and do a quick introduction of our speakers today. With us today, obviously, my name is Colin Pennington, for those that did not jump on at the top of the call. Joining me today is Marcia Conley, who's our Director of Supply Chain here in the U.S. She has got her finger on the pulse of everything going on as it relates to product procurement and what impacts things are having on both the supply chain and logistics front. Dan English is the general manager of FBN Financial. He'll be joining us later on, as we mentioned, to talk through what some of those financial solutions will be. And then David Bauer, who's a commodity analyst here at FBN, is going to talk about some of the macro and economic pieces that are tied to it. So without further ado, I'll go ahead and jump us right in and turn things over to Marcia to kick us off.
Thanks so much, Colin. Good afternoon, everyone. Thank you for joining us today. As Colin said, I'm Marcia Conley. I'm the Director of Supply Chain for the U.S. here at FBN. And I'm here today to walk you through the timeline of events that you see on the screen here. There's been a lot of rapid fire changes when it comes to tariffs, and some of them go all the way back, more than a decade. So we're going to start with the World Trade Organization tariffs that were enacted in 1995. That was, member nations agreed to fairly trade between themselves at rates of 3.5% up to 6.5% generally. Layered on top of that, you have a couple of fees that U.S. Customs applies to any inbound containers coming in from ships. And what you end up with is like a total tariff rate of a maximum of 7%. When you jump into 2018 with the first Trump administration, you see the first round of tariffs against China. That's when the Section 301 tariffs were enacted. And those tariffs are applied in 4 tranches or lists. All agrochemical products today are typically in lists 3 and 4. And as you can see here, each one of those lists has its own tariff rate. When you get into list 4, it is further subdivided into 4A and 4B. 4B is important because the products on 4B had a 15% tariff rate, but that was indefinitely suspended. That is good news for us. There's, a couple of really high volume products like glufosinate technical, glyphosate technical that are on that list, and that's helped keep our prices low for the last several years. But, the caution here is with everything changing so rapidly and so constantly, they could decide to end that suspension at any given time, and that 15% would come back into play. Fast forward to the more recent events, and we get into the new Trump administration, and we started hearing about tariffs in February, and they really started to take impact in March. The first tariffs that were enacted were the so-called fentanyl and migration tariffs that were part of a declaration of emergency for the United States. That's how they did it, through an executive order, and it targeted Canada, Mexico, and China only. So China was given a 20% tariff rate, and there are no exemptions to that 20% for the agrochemical products that we deal with today. For Canada and Mexico, the rate was 25%, but there is a little bit of a carve out for goods that are qualifying under the US-Mexico-Canada agreement. So that's the free trade agreement that was negotiated in the first Trump administration. You're probably thinking like, okay, great, we can send our raw materials to Canada or Mexico and formulate them and bring the finished goods to the US and avoid that 25% tariff. But I'm here today to tell you that they thought of that loophole and they definitely closed it. And there was a clause in that US-Mexico-Canada agreement that says, it has to undergo a substantial change. I won't go into the details of what that is, but by and large, the agrochemical products that we deal with would not go through a significant enough change to avoid that 25% tariff. That takes us to April, just a few weeks ago, where the most significant hit from tariffs really started to take shape. This is the group of reciprocal tariffs, or so they're called. To break it down simply, it started with a baseline of 10% on all countries. And then 60 of the so-called worst offender countries that were deemed to have, an unfair trade balance with the United States, they were given higher rates of varying degrees. You saw, India, I think, had 26%, the EU 20%, and so on. China obviously was singled out with, if not the highest rate, or one of the highest rates of 34%. This was quickly kind of changed and downgraded. The higher rates were suspended or postponed for all countries except for China. And so that means everybody has a 10% rate right now. That suspension was, supposed to only be about 90 days. So it could come back around in a couple of months here that we see those higher rates come back into play. But the real impact for us is China, because the bulk of the capacity for the world is coming out of China for agrochemical products. And because China retaliated and it kind of became a back and forth trade war, we are now at a point where the reciprocal tariff rate for China is 145%, and they have put 125% back on our goods entering their country. A little bit of good news here is that there is a Annex 2 list to these reciprocal tariffs. And what that means is if your product's HTS code, which is a harmonized tariff code, if that code is on the Annex 2 list, it is exempted from these reciprocal tariffs. The rest of the tariffs still apply, but the reciprocal does not. So as you can see, if your head's been spinning, you're not the only one. This is a complex, difficult thing to navigate because you have to take all of these different tariff rates into consideration and understand how they do or they do not apply to the products that you're buying today. So that takes us into, how does this impact our supply chains? As I just alluded to break it down really simply, the goods coming out of China for agrochemicals are going to have on the low end a 25% tariff. On the high end, it approaches very close to 200%. When you get into that 200% range, we're almost talking about an embargo level where it's just not even something that people can afford to buy, let alone resell to you at a price that, is affordable. The good news is, suppliers, including FBN, took action pretty early. I think everyone knew that coming into the Trump administration, he had campaigned on, putting tariffs on China in particular. So a lot of anticipation leading up to Inauguration Day, thinking he would do that on day one, meant that you saw suppliers front loading with a lot of inventory heading into the season. So you probably haven't felt a lot of impact yet in terms of price increases or stockouts, because by and large, a lot of that supply got here before the end of January. Even into February, like the 20% tariff wasn't great, but it was manageable to an extent. You could do modest price increases and still keep products flowing in. But then once we got to April and you see these really drastic tariff increases, and they're happening constantly, if not, daily, weekly, hourly. We rapidly got into a place where suppliers are pausing, if not halting all buying altogether. What we're hearing now is, the ports, particularly in LA, Oakland, our biggest ports on the West Coast, where goods would reach within, about 4-6 weeks at the longest coming out of China. We're starting to see that impact at those ports right now because we're almost a month away from when those April tariffs took effect. We're hearing that, the ships coming in are at a rate of 30 or even 40% less than they were a year ago today. What that means is, that there's no goods flowing in. So what's here is here. The prices that are here today are probably the last that you're going to see before we start to bring in new goods at these higher prices. And you're probably going to start to see some stockouts. Unfortunately, it's not easy to remobilize these supply chains. It's going to be disrupted for a while now. And you're going to see carriers, even with the United States, for, trucking, for rail, they're going to start to reduce their capacity. So the moral of the story is, even if Trump changes his mind tomorrow and we go back to, a lower rate of tariffs, or the tariffs go away and we go back to where we were a few months ago, it's going to take, probably the rest of the calendar year for us to really remobilize those supply chains and start to see goods flowing in at a steady clip. So that's what I was here to present to you today. I'm going to hand it back off to Colin to kind of go through some price and availability things as they apply to the goods that you use today.
Yeah, and Marcia, certainly welcome you to chime in as I run through some of the stuff. Before we do, we're going to take one more effort at this poll question. So Stephanie and Megan, if we want to go ahead and relaunch before we get too deep into some of the conversation here. All right, we're going to go ahead and skip it. We'll come back and try again later. So as Marcia said, supply has the potential to be as equal a concern as price. And when we think about what's going on, there's a lot on this slide. And so bear with me as I kind of walk through some of the different pieces of this. As Marcia said, many industry participants did buy ahead. We saw a lot of AIs coming in at a higher rate than normal, glufosinate being one of them. We think about that January, February timeframe. So it's not a matter of is there supply or is there not. It's more a matter of when and where is it coming from and who has it. Because there's still more supply needed in the market. And that's ultimately, one look at this graph is we think about year-to-date imports as a percent of total demand historically over the last 5 years, and some of the products that have come in. Nothing, through March really was at or exceeding 100%, not on this chart anyway. We talked about glufosinate, and there are certainly exceptions to this. So there's product that needs to come. That doesn't mean that other manufacturers aren't sitting on supply. And so, the goal here is not to sound an alarm. The goal here is to express the uncertainty that does exist, even with the extra information that we have in looking into the market. And so, we're going to start to look at some of those delayed positions. That's going to mean one of two things. It's going to mean price, which we'll talk about a little bit, and we've already seen that across the industry. It's also going to mean shortages. It's not unlike, what we hear from major retail. We've heard a lot in the news lately, whether it be Target, Walmart, other large retailers saying, hey, we're just not going to buy. Right. And so we're going to look across the agriculture space and start to realize that it is just not feasible to start purchasing more product at some of these costs. So we're going to be at the mercy of what is in the supply chain already and who has what. And so all the more reason, as Marcia kind of alluded to earlier, we want to make sure we stay on top of getting what we need now while we can, because what we have now is what we have without the tariffs having impacted too greatly yet. We think about some of those products that are still, while they might have come in at a higher volume early, year to date through March and in March, when we typically see an influx, products like clethodim, glufosinate, 2,4-D, we're seeing relatively small percentages of come in. So it's not just a price piece. There may be instances where it's just not possible to get the product. And so when you look at this graph, especially as we start to get into and out of planting season and into our in-season time frame, we think about the fungicide and insecticide market. Things like lambdacide, azoxystrobin, not a lot came in March. And so where does that leave us for the remainder of the year? that's part of the uncertainty. And so again, not to cause alarm, but want to make sure folks understand it's not all just price. But on the pricing front, there's a couple other things we can look at, and there's a few graphics here that are pulled from FBN's price transparency model, and you can ignore the green dots for the time being. What I want to look at is some of these blue lines. We kind of said coming out of the end of the calendar year in December and into January, we expected prices to go up. Regardless, there's price changes that happen seasonally, and you can look at the ebbs and flows of these charts and see where there are some products that, hey, this is the time of year where price typically does go up. But we can also see as we look at the blue dots, each of those blue dots represents, a 4 to 6 week period in time over the timeline where FBN members have submitted invoices from their ag chem retailers to us, and we've charted these. And so this isn't us pulling intelligence from other random places. This is folks like you who have submitted your invoice data and shown. And as you look across these 6 actives here with glyphosate, S-metolachlor, 2,4-D-glufosinate, paraquat, and atrazine, every single one of these has started to show a pretty significant uptick in price, even when we go all the way back to January. And so we can start to look at, for some of these, those first couple dots, we can say, well, that was concern around tariffs. Now it is becoming more and more of a reality. And in the case of something like paraquat, you can see that bigger spike. S-metolachlor has had a bigger spike. Glufosinate even has had a bigger spike. And there's certainly some other things going on in the market with glufosinate related to other products that are out there that it can impact that as well. So again, more on the uncertainty. But prices are starting to show to be up double digits and are expected to continue going up in May. And so, it's just the time to think about if there's still products that we need and haven't purchased, what can we do to get ahead of that? Make sure not only that we're getting price in a controlled fashion, but that we're also getting the product while it's here before it either becomes unavailable or the price goes up to a level that we're not comfortable investing in the crop. And so just a little plug here, those graphics, as I mentioned, came out of our price transparency tool here at FBN, and all of you have access to this, first of all, through just the pricing that we put in the store. Obviously, our goal is to get as competitive of a price as we can. The way Marcia and her team go to procure product and the way we bring it to market is in a manner that is designed to give you as much savings as possible. But you also have the ability to submit invoices from other retailers if you're buying from various other sources. When you submit those invoices, they are anonymized and put into the pool of data that churns out those charts. And there's another example of that here. But once you've submitted an invoice and it's been validated in our system, it gives you immediate access to the historical pricing over the last 12, 24, and even further out months as it relates to what the pricing that our intelligence tells us has been on those products over that period of time. It'll also highlight if you've purchased those products, whether it be on the invoice you submitted or you purchased those products from us. It will plot in there as well a way to show, what you bought versus what the market was at the time, and also gives you some insight into those trends that we showed. And with that also spits out what we call a shopping list, which allows you to view and see what of those products that you maybe bought elsewhere you could buy from FBN, and how are those priced competitively and positioned against where you bought them from. So if you haven't had a chance to do this already, would certainly encourage everyone. We'll have a couple of links at the end of the session here that will be a quick click into that section of FBN.com, or if you have the app. But on any individual product page, there's also a price transparency tab. You can go in and submit that invoice. It's just as simple as uploading a picture on Facebook or Instagram or whatever social media platform you may prefer. A couple of clicks and that invoice is submitted, and often very, very quickly turned around and validated, giving you access to this tool. So that covers pricing. So now we're going to get into a little bit of the state of the market and talk both grain markets and kind of a macroeconomic outlook. And so I'm going to turn things over to Dave.
All right. Can you hear me?
Sure can.
All right. Thank you for joining the call today, everybody. It's good to be able to get out and share some thoughts with you. First off, I want to focus on the trends by commodity there in the middle of this slide. And I just want to give a quick shout out as well. FBN's combined corn and soybean acreage estimates had 0.1% or a variance of 200,000 acres different than the out of the total 178.8 million acres of corn and soybeans versus USDA's planting intentions report. My point I want to make here is thank you to all of the members that participated. Thank you to all the members that participated in. Is muted. Can you hear me now?
Loud and clear.
I had some feedback there for a moment. I'm not sure what you did here and so on, but thank you to the members that participated in the survey. I'm having some technical difficulty. Things are turning on and off here. Now I think I've got it rolling. But thank you to the members, because I think without your participation, we wouldn't be able to continue to be industry leading in putting that survey together and bringing that forward to our members. First off, just to kind of give a quick wrap up of some market information, the market today, in the last couple of days anyway, based on May expirations and maybe first notice day coming into month end, gave us a little short covering rally on Wednesday. We kind of backed off a little yesterday, and now today we firm back up. I think some tariff talk. Hopefully we've realized that playing out the U.S.-China negotiations in the headlines wasn't the best thing for negotiations, and I think that backed off for a few days. And now this morning we've come out and Beijing has opened the door to have talks with the U.S. The Chinese Commerce Ministry stated that they're interested in de-escalating the trade war a little bit, and we'll move forward from there. So that's a positive. We're also hearing that Trump's going to sit down next week with the new prime minister in Canada. There's also a proposal on the table from the EU. So a lot of things starting to move on that front. Scott Bessent and the White House economic advisor Hassett have both expressed hope for progress in easing trade tensions and suggest that this process, at least with China, first we'll need to de-escalate, and then we'll start focusing on a larger target, a larger trade deal. So anyway, if I go past this slide, we'll talk a little more. This first, I want to emphasize that these figures on the slides are based on forecast data from the U.S. Department of Commerce and the Bureau of Economic Analysis. If we focus on the right side of the chart, we can see that the net result of these initial forecasts are for gross farm income to be up just under $650 billion for 2025, just below the peak in 2021 and 22 when it topped out at $675 billion. The next line down, production expenses, flattening a bit to a little lower. We expect it to be approximately around $450 billion in 2025, down about 0.5% year over year, and about 5% below that 23 peak. The net result that we're getting to here, the net result is for net farm income to rise year over year by about 30%. That forecast is to hit around $180 billion in 2025. But what we need to do is also talk about that this is tied to a $33 billion ad hoc disaster aid payment. So while farm income looks like it's healthy at first glance, this year's increase is largely due to a temporary government support program, not an underlying improvement in profitability. So we'll have to watch that as we move forward. On the next slide, first to talk about on the left-hand side of the slide, using current USDA acreage of 95.3 million acres, and then the February World Ag Outlook Board 181 yield per acre yield, and based on they take that based on the trend line forecast, but that creates an initial production and then carry out of around 2.2 billion bushel, and that's around a 14.3% stocks to use ratio. So just keep that in the back of your minds. And as we look at this chart, on the left-hand side of the chart is the yield numbers that USDA comes out with in the May WASDE. And then the right side of the chart is 11 months later, as they come in to close out that crop year and get a carryout figure in April of the following year. The point to make is that 6 of the last 6 years, all 6 of the last 6 years have been started with a yield estimate and seen that fall from the initial May estimate into that following April. As an example, the current carry out for old crop has fallen now down to about 1.465 billion bushel. That's at about a 9.6% stocks to use ratio. Now, if you roll back 11 months, we were probably around a similar place with yield forecast and stocks to use. So that just shows you that we can see that drop down. So that's for corn. We'll come back to this chart in just a second. On beans, the reduction in acres at the expense of corn puts bean acres around 83.5 million acres. And using that initial 52.5 bushel per acre yield, that puts expectations projecting about a 300 million bushel carryout. That's a sizable carryout, but it really only leaves us about 4 bushel per acre margin that would take us down to pipeline needs through this growing season. So that's just an idea of where we start right now before this May WASDE with the projections for 300 million bushel carryover. On the wheat side, the current situation in wheat is that we're oversupplied here in the U.S. But now on a world stock standpoint, we are a little tighter. So that excuse me, that condition right now is obviously, when you look at the markets and we're pushing new contract lows on the wheat, that's where we are today, and that's what price is interpreting. But I want to take a closer look at this chart, and if I refine that down, and this is kind of a pop out zoom in on that, over the past year, excuse me, 6 years, we've seen about a 2.5% drop, or 4.4 bushel per acre drop in yield from that initial May WASDE into the following April. And so that's just what I'm trying to lay the foundation right now for us to think about with prices where they currently are, with the WASDE coming out 1 week from next Monday. We're starting to lay the foundation for what this crop does. Currently, U.S. planting progress, this is as of last Sunday, was 24%. That was up 12% from the prior week, and that 24% is versus 25% last year and 22% on a 5-year average. Bean plantings at 18%. That was up from 8% the prior week, and based on a 5-year average of that's 6% above a 5-year average. So we're well ahead right now on a record pace for bean planting. Spring wheat seedings at 30%. We're up 13% week over week, and they're 9% above the 5-year average. So just to kind of give you the flavor, we're kind of planting progress is coming in, even with the rains that we've seen over the last couple of weeks. Planting progress is moving right along. And the first week winter wheat conditions report, they've been coming out over the last couple of weeks. And right now, last week, we had about a 4% increase in the good to excellent conditions that put us in line with the 5-year average. So from a condition and also a progress standpoint, we're ahead of average on the planting progress and right in line with conditions right now. The real point to make is the drought monitor came out this past Thursday, and over the last, if I go back 3 to 4 weeks, 3 and 4 weeks ago, we saw the drought monitor kind of moderate with the rains that we had seen at that point. And then after the fronts that have come through over the last week to 10 days, you thought we would have seen more improvement to the drought monitor. We did see improvement, but not quite what I thought we would have seen. So it brings into focus this picture, this chart that we have here in the slide, where for the last couple of months we've been talking about the July, August, September precipitation outlook was for warmer and drier in the Midwest. So the point I'll leave us with today is we've had a pretty good start to the planting, and conditions are coming along well. And now we get into a period of time where the moisture is to slow down. We're to see the weather systems coming through this weekend to move further south and southeast, and should allow for some good planting over the next week to 10 days. And then we're going to start getting out into that period of time where these the forward outlook for warmer and drier comes in play, and the market will base price whether it needs to factor in some risk premium or take out more condition premium if we see improvement. So that kind of wraps up what I have right now on the market and current outlook. And I'll hand it back over to you.
Yeah, I'll take it from here, and we're actually going to turn things over to Dan, I think, and kind of start to walk through what some of these financial solutions can look like. Dan, I'll turn it over to you.
Great. Thanks, Colin. So if you go to the next slide here, this is just showing the GDP growth rate quarterly over the last couple of years. And you'll notice, we've generally had some pretty good growth over the last few years. But as Marcia and others pointed out, we had a lot of importing done right before the announcement. And so the way that works for GDP calculation is the imports are all subtracted from the GDP number. This is, I think, one of the largest negative net import numbers we've ever had. Or sorry, net export numbers we've ever had. And so what that means is GDP shows up as being negative, even though consumer spending was growing. We just had a good employment report today, but the headline growth number is negative. And so the question is kind of what's typically happens when we see periods of economic slowdown, and is this an economic slowdown yet or not? And so if you go to the next slide here, Colin, what we saw during COVID, kind of early 2020, is pretty typical. And this is showing the interest rates here for the 10-year Treasury, which is one of the key benchmark rates, and then the 30-year fixed, 5-year variable, and 3-year variable rates from Farmer Mac, which is the baseline within the ag market. And you see there, as we entered into COVID and the economy slowed down, the Federal Reserve lowered rates to boost the economy. And then kind of starting in 2022, they started to raise rates, and as inflation expectations went up, those rates went quite a bit higher. And so that's typically what you'd see is, if we enter a period of economic slowdown, you'd see rates fall a little bit. But as we see inflation expectations and inflation results go up, you'd expect rates to rise. And so the question is, what does that mean for the era that we're in right now, particularly with these tariffs? And before we go to the next slide, the only other thing I would point out here is a lot of farmers locked in their rates during that 2020 to 2022 period. And so they have relatively low rates, and they're locked in on their farmland at those rates. Now there may be a need for working capital, and so the question is, how do you get that out? And then you also have some farmers who've bought land or had to refinance or do something else over the last year to 2 years. And as you see there's kind of a plateau of a higher rate. And so it really depends where your rate's at as to what your kind of total cost of production is. And so we want to figure out, is there an opportunity for rates to go lower and you to save some money, or are we kind of stuck at this higher level? So if you go to the next slide here. So, and what's happened here? Well, as we entered or kind of got close to Liberation Day, you'll see that, and that's the pink part on the right-hand side of this chart, rates started to go down. And then right on Liberation Day, the rates dropped. And so it looked like, hey, maybe we'll be in this period of a much lower rate policy. And that would make sense. If the tariffs were much higher than were expected, there was a lot of speculation that this would dramatically slow down the economy. And there's typically two things that would happen in that scenario. One is, in general, when rates drop, there's what's called a flight to safety, where people don't want to own riskier bonds or they don't want to own stocks, and they'll buy treasuries because treasuries are the most stable and likely to be the least volatile in those scenarios. And so that's one part of it. The other part is, as we talked about before, if there's an economic slowdown, typically you'd see rates drop. And so those two factors combined, you see the rates drop very precipitously kind of on that April 1st day. Then right after that, they spiked. And the question is, why did they spike? Some of it was expectation of, hey, this is maybe a little bit different than previous issues that we've seen with the economy, and that typically these were a function of slowing consumer demand or something like this. Whereas here, this is a tariff issue, which means goods prices are going to go up, which causes inflation, which then means that the Federal Reserve might be raising rates. There's also a question of, well, if we're trading less, we are giving other people our US dollars in exchange for their goods. And if we're trading less, if we're buying less from them, that's one of the stated policies here, then in fact, there's going to be less demand for US dollar denominated debt. And if that's the case, we still have the same federal debt that we've got, but if less people want to buy it, then there's just supply and demand, prices go up, and so you see a spike. And then the net of all of that is, if you look at the very end of this chart, rates are basically back where they were before we entered Liberation Day. And so the question is, are they going to continue to go down, or are they going to respike and go back up? And so the answer to that and what you would do with those two pieces of information really depends on your outlook as to what's going to happen with the economy. And so one question is this a permanent change to how we're going to conduct tariff policy, or is this a one-time negotiating tactic? And so there's been some discussion that we'll have an external revenue service, that this will be a permanent source of revenue for the government, that we want to have these barriers in place because we want to have more domestic manufacturing. And that would certainly point towards these being a permanent increase in barrier. Sorry, looks like I had a little IT issue there. In which case, these rates would be, tariffs would be permanently higher. You might associate a slowdown with that. Or if this is simply a negotiating tactic, in which case you might expect there to be more growth. In which case, that would potentially push rates higher over the longer term if we have a very strong economy. The second is, will this cause a recession, or is it going to be a wave of growth and reinvestment? And if it's a recession, again, we'd expect rates to come down. But if this is really solidifying the economy and preparing a wave of growth, then you would expect rates to remain, elevated. And then my apologies, my internet keeps cutting out here, so I'll kick it over in 1 second. But are there any permanent changes to how investors view the U.S. debt? And if that's the case, if they're permanently going to buy less, then we would expect rates to remain higher, and then to a lesser extent, domestic investors. And so really the answers to those questions will inform, hey, do I want to lock in rates right now because I think they're going to go up, or is there actually an opportunity where rates are going to come down here in the near term, and I should think about refinancing? And so if you look today where the rates are, we see a lot of farmers doing this 3-year variable rate with a 30-year term. A little bit less than 5.5% is a terrific rate over any long period of time. But the 30-year rate remains relatively high at a little bit over 7%. And so as you think through the moves that you should make, number one, there's a couple of no regrets moves you can make. is there any debt today that you can refinance to save on your interest expense? That's certainly a big question. If you took out a loan in the last 2 years, there is some opportunity to save, particularly if you choose something that has a bit more of a variable rate. The second question, or the second thing you need to be thinking about, is making sure you're utilizing the full suite of tools you have to boost your working capital. So do you have an operating loan in place? Can you draw more on land? Can you do some cash out refinances there? In general, if there's a time of uncertainty, you want to make sure that you have access to as much working capital as possible. And then finally, the biggest thing, and we talked about this in almost all of our meetings, is making sure that you know your numbers. And so what's your cost of production? What rates do you have today? Where can you potentially save? And that's going to be most likely the thing that's going to set you up for success. So with that, I'll turn it back over to you, Colin.
Prices are, trying to figure out still what we're going to do in the upcoming season. Oftentimes we talk about how we're going to sharpen the pencil. And not to say that that's wrong, but when we really start to look at it, what we really want to be looking at is how do we sharpen our focus on ROI, and how do we use agronomy to do that? Because at the end of the day, what we're wanting to do is maximize every potential bushel that we have out there. And so when we think about that from an agronomic perspective, sharpening the pencil doesn't have to mean we stop doing things. Certainly is going to change the way we evaluate things, certainly can change the way we do them, but it doesn't have to mean stop. And similarly, when we focus on ROI, it doesn't have to be additive. Doesn't mean we can't. And I think there's plenty of opportunity out there to think about what are some things we want to double down on, what are some things that we maybe haven't done before that do make sense. But it doesn't mean we have to do that. It doesn't mean we have to spend more, right? It's rethinking about how we put these evaluations together. And so we're going to talk about 3 topics quickly here. One being product efficacy, making sure we're picking the right product for the job. How do we focus on that as we select our products going into the year, both tied to what's going on in the markets, what's going on with the trade war and pricing and availability, but then also just understanding what's actually working for the job we're trying to do on the farm. Spray tank optimization is another big one. I think adjuvants can sometimes be in a situation where, especially some of those value add pieces in a down year where cash might not be as available, or we're worried about what our production costs are, that we say, oh, I'm going to skip that one, right? And so we'll talk about maybe some reasons why we don't. And then drought mitigation. Certainly some portions of the country don't want to hear about drought because it's done nothing but rain for the last month. I'm here in Missouri, and I think we just set a record for rainfall in the month of April. So, but as we go further north and west, we have places that not only were already in a sustained drought or somewhere in that low end of the drought monitor, but then we can also look at what's happened with winter snowfall and how little we actually had to help increase the water in that water table. So we'll talk through some of that as well. But starting out, fungicide use and efficacy, as we move into the year, this can become one of those ones that we first jump to as this is my optional move, right? But let's maybe not think about that. Let's think about it under the context of, hey, how are we going to protect the crop that we're putting in the ground and make sure that we get the most out of it? And so 3 big things to consider. The first being not all fungicides are created equal, but counterintuitive to that, there are also some that might be more equal to each other than we realize. And as a marketer myself, I don't want to overexpose it, but I think a lot of times the fungicide market especially is built a lot on marketing. And so how do we kind of fight through that using some of the resources that are out there that we all have access to and understand, what is what I'm buying going to do for me? Number 2, understanding the disease pressure that we have, not only that we expect to be there or that we might start seeing as we start to get out and scout fields later in the season, but also what might be coming. Historically, what do we deal with? What have my neighbors dealt with? And how do we think about that? Because if we take too myopic of a view as we look at our fungicide selection, we can start to do some things to put ourselves in a situation where suddenly we're behind the curve on other diseases that we weren't thinking about. And then we have to look at that evaluation of, do I spray a second time? Did I spray the right product? And so how do we avoid that? And number 3, don't count out the generics. We kind of talked about a little bit the marketing that goes behind fungicides and what the active ingredients actually do. There's some key opportunity as we think about, purchasing generics, and we certainly love the opportunity to earn your business here at FBN, but just giving you the power to do some cost analysis on your own, using some of the digital tools that we have available and understanding what's the product doing for me? What am I paying for it? And what's my expected ROI? And so an example of that, we talk about fungicide efficacy, and we can think this is a particular example around corn. We can look at southern rust, northern corn leaf bite, gray leaf spot. Tar spot's been one that's taken up a lot of bandwidth and conversation in recent years. And we look at the different modes of action and the different active ingredients that are out there to help us fight some of these key diseases. What are they actually doing? What are they costing us? And what are my alternatives? And so this is information that our agronomy team here at FBN and Dr. Mitch Roth, who's our regional proprietary agronomist for the East region, has pulled together from the Crop Protection Network, which is a pool of extension experts from numerous land-grant universities and other third-party resources across the country to really evaluate what are some of these active ingredients doing against the diseases that we're using them against. How well do they work? And so as you look across the chart here, southern rust and a lot of the rust diseases are ones that, I'd say 5, 6, 7 years ago, we were the most concerned about. And so whether you're looking at straight azoxy prop, you start to get into your prothioconazole, like a Proline, or even Delaro in today's age, you can see pretty good coverage across all of that. But as you go down the chart, especially as you get to gray leaf spot, you can start to look at, okay, well, there's a couple of places where we have an unknown rating. Tar spot is a big example. Delaro, that prothioconazole and trifloxystrobin has been suited very well for tar spot. Azoxy prop, while not formally known, is one that we do have a FIFRA Section 2 label for use against tar spot. It's still hard to say exactly what that efficacy rating is. But again, another example of the resources that we can use to look and see, what am I dealing with now? What do I constantly deal with versus what might I be dealing with later in the year? And so you can see across the bottom there, what the approximate cost is per acre for an application of these products based on the member submitted data, the data you all have provided us to look at either the branded or the generic alternatives to these, as well as what FBN currently offers. And so when we think about, what we're paying for some of these, you can get all the way over there to that, Delaro or that generic Delaro space. When we think about the range of cost, anywhere from $14 to $20+ an acre, we really want to put an evaluation to that. We know firsthand what the impacts of some of these diseases. Southern rust, while not near as frequent, can be devastating. Tar spot, in the years that it's shown up and been rampant early, can be a problem. So how do we evaluate that, get ahead of that, and start to think about where we put cost towards protecting that crop without putting extra cost into it? So there's a lot more technical detail that we can go in here. And so I would encourage everyone, early next week, you'll see an invite. We are going to have a webinar. I've talked about Mitch and Chris O'Hare, who's our agronomist out in the West region, are going to be putting on a webinar about managing diseases in a volatile season on Tuesday, May 13th at 1 p.m. So you all get an email with an invitation to that. If this is something you'd like to learn more about, get more details, ask questions on the technical side of things. These guys are a wealth of knowledge, and looking forward to bringing this presentation forward. So stay tuned for that one. Spray tank optimization. 3 big things to consider as we start to run out of time here. I don't want to cut things short, and I want to leave some time for questions. But do I have the adjuvant I need to get my herbicide or my fungicide to perform at its maximum potential? It's not the time to be skipping out on what is going to make the product we've already purchased more effective. Number 2, quality matters. There's a photo here, and one of these is a low-cost crop oil concentrate, and then the other is comparing it to implant, which is one of the adjuvants that we provide here at FBN. And really, it's just to say what can come out of using either a low-cost product or a product that does not have near the quality, right? And so you can see from left to right what happens when we mix the product, what happens when we blend, and what does it start to look like 60 minutes after that blend. And you can start to see things separating out. Those are all things we don't want to see, right? And so as we think about, it should be more about maximization versus cutting. And then finally, what kind of foliar feeding or plant health are we doing? If we're making that pass across the field, whether it be for fungicide, insecticide, there's even good options for things earlier in the season as it relates to our early post-weed control sprays. Nourish Vitals being a product that comes to mind here at FBN, but just something to think about as we think about making sure we maximize the plant and get the most out of it moving forward. Insorb ADV, another one of those from FBN, non-ionic surfactant designed to improve that plant uptake. It is APE free, so in your corn acres, reduces that risk of arrested ear development. APE is that element tied to arrested ear, and also meets our pesticide label requirements for a non-ionic surfactant. There is a short video here. I will make sure the video makes it out. It's not playable in current format, but just kind of shows you what the benefit of having all of that in and what it does to the spray droplet as it makes contact with that leaf, and how you can do that moving forward. And then the final point, drought stress mitigation. David talked a little bit about, what things look like from a long-term forecast perspective. I pulled a couple of examples here, the bottom being the U.S. Drought Monitor early in April. So we can see that area across the northern plains and out west. And you combine that with the top image, which is the departure from average snowfall throughout the course of the winter this past year. And so we're going to be looking at areas where we are very, very dry. Some of these areas have certainly mitigated some of this risk with the amount of rainfall we have had in the last month, but we know there's a long season to go. And so making sure that when we get out to plant, we're finding the moisture, knowing what residuals are going to perform in those moisture limited scenarios. So we think about our group 15s, think about acetochlor versus S-metolachlor. Oftentimes that acetochlor molecule, depending on whether it's encapsulated or not, either way, is going to require a lot more moisture to activate. If we're not planning for a lot of that expected rainfall, are we planning for the right product in the tank that can still perform when we don't have the rainfall that we need to activate some of those traditional residuals? And finally, biostimulants, another opportunity that can help prime the plant for that stress and help it respond to that environmental stress, whether it be heat and drought stress. It can be stress from the chemicals that we're applying in our post-emergence weed control. There are a bunch of products out there that can really help develop that plant, get some more early season vigor, and leave it in a better place so that if we do meet some of those unexpected challenges throughout the course of the year, we're ready to go. And so there's a lot more agronomic information that come out of this. For those of you who have not had a chance to meet with or have a conversation with the regional agronomist in your region, we do have a team of 6 agronomists across the country that are here to work with you. Talk to your FBN rep. If you got questions, there's also a help button throughout the website. Anytime you're navigating FBN.com or in the app, when you click on that, you can connect with someone, connect directly with your rep. And you can also start to look at how you figure out how to get in touch with one of these guys. But outside of that, there's also 24/7 support. And so from an agronomic perspective, what we want to do is make sure that we're controlling the controllables, especially in a year like this. And so we've got control of what we're putting in the tank. If you have questions, Acre Plan is there for you 24/7. If you haven't played with this tool, I would really encourage you to, as you can walk through and see what are the different options I have at each stage of the season for my crop, and start to understand what are some of the trade-offs, what are some products I could use in place of products I've used in the past, whether that be because you're planning for environmental factors or you're dealt with availability of product and price that you don't want to have to deal with. You can look for what some of those agronomic alternatives might be. We talked about price transparency and controlling who you trust. As I mentioned, we certainly love the opportunity to earn your business, but at the very least, would really encourage you to submit your invoices, take a look at that price transparency, and use that data to put some power back in your hands as you're trying to make sure you get the products you needed going into the season. Control when you buy. We've said it. A lot of people have said it. Prices are going up. They're going to continue to go up. Get ahead of what you can. In cases where you do want to control that pencil, we talked about the pencil. You can do the math. We can help you do the math. On every FBN product page within our store environment, there's a button that says help me calculate. And based on what you're doing, what crop you're applying to, what product, what tank mix you're using, we can help calculate exactly how much of the product you need based on label required rates and or recommended rates. Makes doing that math, figuring out how much I need, what it's going to cost me broken down to the acre in an easy place. And evaluating your seed choices, whether you still have some seed decisions to make, or we start to think about late season crop switches in the South, starting to get on top of what our double crop acres look like. Our seed finder tool is a great opportunity to go in, look at what seed performs in the environment you're in the planting timing window that you're utilizing. Look at the member supported data from our precision files over years. We've got 10 plus years of data in there to really start evaluating what seed products are the same or similar to the genetics in the seed products I'm planting. What have other growers had success with in my area based on planting date? available moisture, all those types of things. So to wrap things up, just, in a year like this and with everything going on and all the uncertainty, what we want to do is really avoid taking risks that reduce predictability. Cutting corners can always save us money, but not without added risk. And so making sure we stay ahead, buy what we need while costs are controlled, and plan for the worst by knowing what we could need. Even if you're not going to buy it today, understand, in a perfect world, what do I need? What am I going to do? And if you're not going to buy now, you're not in a position to buy now, know who you're able to trust when you do need it. We're obviously here for you. Would love to hear from you, but planning ahead, getting ahead of what's coming up in the upcoming season is the best thing we can do. There's continually, uncertainty day by day, tariffs on, tariffs off. We're going to continue to monitor that, and we'll certainly look at providing additional information through webinars like these as we move forward. Should we get the opportunity to, should we need to, if things start to go the other direction, we'll obviously be happy to share that information with you as well. So appreciate everyone joining the call today, and appreciate all the presenters that joined me. We do have some time for some questions. There is a little bit of key questions that have been submitted here. I may, for my fellow speakers, start to call some of you out as I flip through these. And so I will turn it over. If you have a question that you haven't already asked, please feel free to drop it in the Q&A, and we will address some of those as we go here as well. And so, Marcia, I'm going to maybe start by picking on you a little bit. There's a couple of questions that are all kind of similar here. But we talked about China, and we called out China specifically. Obviously, we know China's not the only place we're getting product from. It's also not the only place that's impacted by tariffs. So maybe speak a little bit to our ability to, not just as FBN, but as an industry, to move suppliers away from China to try to get a better deal and get away from those tariffs, and what the possibilities or lack thereof might be.
Sure. Yeah. A few things come to mind. First of all, the production capacity within China is so much greater than anywhere else in the world that to replace that quickly
Marcia, I don't mean to cut you off, but I think we lost your audio there.
then oh, okay. Sorry, I'm not sure where you lost me. What was the last thing you heard?
Right at the beginning, you cut out.
Do you have me? Oh, okay. Well, I'll start over. Yeah, I think, the hurdle there is that China has so much production capacity that it is just not easy to move it quickly or efficiently to another country. And no other country has, anywhere near that capacity to just turn on, ready to go today. And to move it to, even India or the US is going to take years, not weeks or months. And then it may or may not be a wise investment if the tariff situation could change tomorrow. No one wants to invest in a brand new factory just for the tariffs to disappear tomorrow. Yeah, and then I think the other hurdle would be, EPA registrations. If you're not already in a position where your raw materials or your formulations are registered with the EPA to source from an alternate supplier in India, you would have to submit those now, and it's an 18-month minimum lead time to get those approved before you could enter the market with those products from those new suppliers.
Any response, Marcia, from suppliers, not just China, but elsewhere, in terms of cost control on their end? Is anyone blinking, behind the backs of these tariffs and saying, I don't want to lose the business, I'm going to try to control costs better and bring things down? Or are we pretty much sticking to what's happening at the surface?
Yeah, when it comes to China, the prices for raw materials in China have been at the lowest that they can be for probably 2 years now. So they don't really have much more room to give up margin or to kind of help us with sharing in the tariff impact. So I really would expect people to be able to help us minimally, if at all. Other places like India that have a lower tariff rate, they might be able to help out a little bit more. But again, they're probably gonna, to an extent, capitalize on a little bit of the advantage of stealing some business and being able to make a little bit more profit than they have in years past if China's kind of cut out of the competition. So that's what I expect to happen as long as these tariffs stay the way they are.
Great. Thanks, Marcia. Any other questions from the group? I know Dave's gone in and answered a couple. I don't know, Dave, if one of those is one you want to answer out loud. as it relates to prior things that were going on in Russia and the Ukraine, and how it impacts our grain markets here. Otherwise, if you've got questions, feel free to pump them into the chat.
Yeah, I didn't have any more on the Russia-Ukraine, but I'll answer one of them on here about China suppliers. Do you see China suppliers lowering their cost any to adjust, excuse me, for the increased cost because of the new tariffs? I did listen to someone speak earlier today about during Trump's first term in the tariffs, China absorbed 80% of the tariff cost. So I just was going to share that. I know that in the past round of tariffs, China did absorb a large part of the cost. So I was just answering that one.
All right, I'm flipping through the questions here. Doesn't look like we have any others. So Megan, if you want to flip us over to the final screen, I'll go ahead and wrap us up. Again, thank you everyone for joining the webinar today. Hopefully this was helpful to you, gave you a little bit of insight into what's going on. Certainly there are a lot of uncertainties still out there. We're doing our best to stay ahead of that, want to communicate that with you as best we can. If you have any questions, feel free to reach out to your FBN rep. There's a few links here in the chat today, as well as a question. We'd love to know what you thought of today's session. Was it valuable for you? So feel free to take that poll before you hop off. There's resources again here. We talked some of the products we talked about, some of those features, price transparency, and the ability to get some of those shopping lists done. Great opportunity. So again, thank you everyone for joining us. Thank you for being an FBN member. Stay safe out there this planting season, and we hope to talk to you soon.